The asset dedication personal investment strategy is made up of four basic components. First comes the target cash flow stream needed for withdrawals from the portfolio. Second is the income portfolio of bonds needed to produce the target cash flows based on dedicated portfolio theory. Third is the growth portfolio of stocks and mutual funds needed to replenish the income portfolio and sustain it over time. Fourth is the critical path that tells if the replenishment should be done this year or wait. Each component has its own video. This video covers the income portfolio. There are two basic types of financial instruments: stocks and bonds. They are fundamentally different. Stocks represent shares of ownership in a company. You're entitled to a share of the company's future profits or losses. Shares of a mutual fund mean you are buying the stocks not of just a single company, but of many companies. If the companies perform well, the value of the shares will go up. If they perform poorly, the shares will go down. Because no one can predict the future, no one can know which shares will go up or go down. The returns are uncertain and unpredictable. They fluctuate over the short term, sometimes positive, sometimes negative. But over the long term, stocks have historically gained more than they have lost, given higher returns than bonds. Stocks are located in the growth portfolio, covered in another video. Bonds, on the other hand, are a debt. When you buy a bond, you are lending money to the company. It has a fixed rate of interest payable at whatever rate is stated on the bond for as many years as it says on the bond. At the end of that time, the value printed on the face of the bond will be paid. For example, a 10-year 5% bond with a face value of $1,000 will pay $50 per year for 10 years, which is $500 total, and $1,000 when it matures at the end of the 10th year. The payments are predictable, certain, and steady. Although most bonds are maintained entirely electronically, here is a picture of a government bond on paper with the coupons shown. With government bonds, this is the type that asset dedication always uses, unless the investors prefer something else, since the risk of any default is practically zero. The process starts by determining the cash flows that will be withdrawn from the portfolio. These cash flows come from the financial plan to cover living expenses, anticipated car costs, etc. These are withdrawals above and beyond any other source of income, such as Social Security for a retired person. They become the target income stream that the portfolio will supply from the bonds in the income portfolio. In this example, a time horizon of 8 years of protected income is shown, with the first withdrawal of $40,000 increasing 3% per year to allow for inflation over the next 8 years. The total amount of all withdrawals in this case is $355,693. The most common time horizon for retirees is 5 to 10 years, but any length can be used. Each year usually requires about 4 to 5% of the overall portfolio, depending on the current interest rates. So, an 8-year income portfolio will take about 30 to 40% of the overall portfolio. This does assume the retiree is following the 4% rule of withdrawals, which is a withdrawal of about 4% of the total portfolio value to start, and increases each year by last year's inflation rate. Here is a graphical illustration of how cash flows from the bonds in blue match the cash flows in brown needed over the 8-year time horizon. No matter what happens in the stock market, this income stream is protected and secure. Here are the details of the 8 individual bonds purchased to provide this income stream. It is almost a perfect match, with a statistical correlation over 99%. It cannot be perfect, though, because bonds must be purchased in $1,000 increments. The total cost of the income portfolio is $339,778, or about $16,000 less than the cash flows supplied. In percentage terms, the income portfolio costs about 96% of the total cash flows supplied. When interest rates are higher, the cost is lower. As each year passes and a bond matures to supply the cash flow needed for the next year, the income portfolio needs to be replenished. After 1 year, the 8-year time horizon of protection becomes 7 years. So, a new 8-year bond will be needed to roll the income portfolio forward, back out to the original 8 years, or perhaps extend it out to 9 years. This will depend on how well the growth portfolio, which is invested in stocks, has done over the prior year. The critical path is used to determine if the growth portfolio has done well enough to replenish the income portfolio, or if it is better to just wait another year. Be sure to watch the video on the critical path. This example is almost the same as the first example, except the target cash flow stream is not steadily increasing. Instead, it is irregular or lumpy. The income portfolio is versatile and can handle this easily by simply changing the number of bonds that it buys for each year to match whatever pattern is needed. This slide shows the details of the bonds. Again, the match is nearly perfect, with a correlation of almost 100% at about the same total cost. In this video, we just covered the income portfolio. Please watch all of our videos to learn about the other components of the asset dedication strategy. You can also learn more about the asset dedication strategy by doing a simple online search for dedicated portfolio theory, reading an article published online in Advisor Perspectives, search for Huxley, Burns, or Fletcher, or by reading our original book published by McGraw-Hill. For more questions, call your advisor or visit our website at www.assetdedication.com.